Imagine you're looking at two different investments, right? And over the past few years, they both somehow gave you the exact same average return, like identical numbers.
On paper, yeah, they look the same performance-wise.
But then you look closer.
Yeah.
You see the journey those returns took. One, maybe it was like a smooth ride, pretty steady, calm waters. The other, total roller coaster. You know, huge peaks, terrifying drops, just wild swings. If you had to pick one, which one feels better to have been in?
Probably not the roller coaster for most people, even with the same end result.
Exactly. It's not just about that final number. It's about, well, the turbulence, the volatility you had to live through. It's about risk.
It really is.
And today, we are diving deep into how we measure that risk. We're putting two really popular metrics head-to-head. The classic heavyweight champ, the Sharpe ratio, and its challenger, maybe a more specialized cousin, the Sortino ratio.
That's spot on. And this deep dive, it's built from a really solid stack of sources, analysis, research, all exploring how we measure investment performance after accounting for risk.
Risk-adjusted return. That's the key phrase, isn't it?
Absolutely. We're going to unpack what that actually means, why it's so critical, honestly, essential for anyone making investment choices.
And then get into the nitty-gritty of Sharpe and Sortino.
Yeah, exactly. We'll look at how they're calculated, what they do well, their strengths, but also really dig into their weaknesses, some of which might surprise you.
And figure out when you might actually prefer one over the other, based on what our sources are saying.
Precisely, using the examples, the data, even some of the debates we found in the material.
Okay, so our mission here is simple. Cut through the finance jargon. Give you the clearest possible understanding of these tools.
Right, so you can look at investments and see beyond just the return number. Understand the bumps in the road it took to get there.
It's really about making choices that aren't just about potential profit, but also about what you can actually stomach, your comfort level with, the ups and downs.
Well said. Let's start right at the beginning then, with risk itself. Because our sources point out something crucial, a common mix-up.
What's that?
People often use volatility and risk like they're the same thing. They're related for sure, but they're not identical. Getting this difference is key to understanding Sharpe and Sortino.
Okay, so break it down. Volatility is
basically just how much an investment's price bounces around. The size and speed of the ups and downs, around its average path. Its jumpiness.
Just the variability. Got it. So how is risk different?
Risk, especially the kind that really worries investors, is maybe better thought of as the potential for a permanent loss of capital.
Ah, okay. Not just bouncing around, but actually losing money and it not coming back.
Exactly. That's the fear, right? Your investment drops hard and maybe never recovers or takes so long it messes up your goals. That's different from just riding out some daily noise.
Right. A volatile tech stock might jump 5% daily, but if it's trending up long-term, maybe you don't mind. The risk is the crash that has its value and takes years to claw back, if ever.
Precisely. And this difference is why risk-adjusted return metrics are so incredibly important. Just looking at total return, it's only half the story, potentially a misleading half.
How so?
Well, you could see a fund boasting, say, a 30% annual return. Amazing, right? But what if it got there by dropping 40% one quarter, then rocketing up 70% the next? That kind of insane ride, that massive drawdown potential.
I'd be totally unacceptable for someone who needs that money soon or just can't handle that level of stress.
Absolutely. So a fantastic return doesn't automatically mean it was a good investment for you. It completely depends on the path it took.
So risk-adjusted return tries to measure that path somehow.
Yes, it helps you judge if the risk you took on was worth it. Did you get enough extra return above what you could have gotten almost risk-free, like from a treasury bill to compensate you for the volatility or potential losses you endured?
So it's like a measure of efficiency, bang for your buck, return-wise, for the risk you took.
Exactly that. And it's probably the best way we have to compare different strategies or portfolios. If two funds have the same 12% return, but Fund A got there much more smoothly, fewer scary drops, less chance of falling below some minimum you need.
Then Fund A was more efficient, lower risk for the same outcome.
Correct. And understanding that efficiency helps you pick investments that not only aim for your return target, but also fit your actual tolerance for uncertainty.
Okay, so we need ways to measure this efficiency. The sources mentioned a few, right? Sharpe, Sortino, Trainer, Kalmar.
Yeah, those are the main ones you'll hear about. Our sources really zoom in on Sharpe, Sortino, and Kalmar. Trainer gets a mention too.
How does Trainer fit in?
It's conceptually pretty close to Sharpe. It looks at excess return, but instead of dividing by total volatility, it divides by beta.
Beta. That's how much it moves with the overall market, right?
Right.
Market sensitivity.
Correct. So Trainer is asking, are you getting paid enough extra returns specifically for taking on market risk? That systematic risk you can't diversify away.
Whereas Sharpe uses standard deviation.
Which captures total volatility, both the market risk and the risk specific to that particular investment, its own unique ups and downs.
Ah, okay. So Trainer, market risk reward. Sharpe, a total volatility reward.
Pretty much. And because Sharpe looks at total volatility, it's become the much more common kind of go-to metric for judging overall portfolio efficiency compared to a risk-free rate.
Yeah.
That's why we're really focusing on Sharpe and Sortino today.
Got it. All right, let's get into the big one then. The Sharpe ratio. The standard.
It really is the industry benchmark, developed way back in 1966 by Nobel winner William Sharpe, originally called the reward to variability ratio, still the most popular kid on the block.
Okay, so remind us, the calculation, how does it work?
The basic idea is pretty simple. You take the investment's return over some period, subtract the risk-free rate like what a T-bill paid to get the excess return.
The return you got above just playing it safe.
Exactly. Then you divide that excess return by the investment's volatility during that same period, and volatility is measured by the standard deviation of its returns.
Standard deviation. A measure of how spread out the returns were around the average.
That's it. There is a slightly tweaked 1994 version using the standard deviation of the excess returns, but the heart of it is, how much extra reward did you get for each unit of total bouncing around?
And higher is better.
Generally, yes. A higher Sharpe ratio suggests you got more excess return for the amount of volatility you had to endure. It's used everywhere, comparing stocks, bonds, funds, entire portfolios.
Any classic examples?
Well, the sources mention the famous Berkshire Hathaway case. Over a long period, like 1976 to 2017, its Sharpe ratio was reportedly around 0.79.
Okay.
Compare that to the overall market, maybe the S&P 500, which had a Sharpe of about 0.49 over that same time.
Wow. Big difference. So Berkshire delivered much better returns for the level of volatility than just holding the market.
Significantly better, according to that metric. It shows how Sharpe can highlight superior risk-adjusted performance.
So its main strength is it's simple, widely used, easy to compare.
Yeah, pretty much. Relatively easy to calculate from standard return data. Everyone kind of knows what it is.
Okay, simple and popular. But the sources also spent a lot of time on its downsides. Where does Sharpe stumble?
Yes. This is where it gets really interesting, and it's why things like the Sortino ratio even exist. The biggest critique, hammered home in one source, goes right back to that volatility versus risk distinction.
How so?
Sharpe uses standard deviation, and standard deviation measures total variability. It treats a 10% jump up the exact same way it treats a 10% plunge down.
But wait, investors like the 10% jump up. That's how you make money.
Precisely. That's the fundamental flaw critics seize on. Standard deviation penalizes all volatility, even the good kind, the upside kind that generates returns.
So if a fund has some huge winning months, its standard deviation goes up and its Sharpe ratio goes down. It gets punished for winning big.
Kind of, yes. It looks riskier, according to Sharpe, even if that risk was just making a lot of money quickly. One source even said Sharpe should be called volatility-adjusted return, not risk-adjusted, because it penalizes all variation, not just the downside potential.
That seems backward. You make more money, but the ratio says you did worse on a risk-adjusted basis. Weird.
It feels counterintuitive, doesn't it? Another major weakness is the assumption behind standard deviation. It works best mathematically when returns follow a nice, neat bell curve, a normal distribution.
But financial markets aren't always neat bell curves, are they?
Empirically, no. Real-world returns often have fat tails, meaning extreme events, big crashes, and big rallies happen more often than a perfect bell curve would predict. Markets can also be more peaky.
So the math underlying Sharpe doesn't quite match reality sometimes.
In those cases, standard deviation can actually underestimate the real potential for extreme losses, making the Sharpe ratio look better or less risky than the situation might truly warrant, especially heading into a crisis.
So it penalizes good volatility, and it might not properly capture the bad kind either. Yikes.
It's a double whammy critique, yeah. And there's more. Because it's just based on reported numbers, it can be gamed.
Gamed? How?
Well, think about strategies holding assets that don't trade often, like private equity or certain complex derivatives. If you can smooth the reported returns, maybe using your own pricing models instead of daily market prices.
You can make the standard deviation look artificially low.
Exactly. Lower standard deviation means a higher Sharpe ratio, even if the actual underlying risk hasn't changed. Some hedge funds have been known to juke the stats, as one source put it.
Okay, that's worrying. Making the number look good without actually reducing risk.
It is, and interpretation can be tricky too. What if an investment loses money, so its return is below the risk-free rate? It has a negative Sharpe ratio.
Right.
Now, what happens if its volatility increases? Counterintuitively, sometimes that can make the negative Sharpe ratio get closer to zero, making it look less bad, even though experiencing more volatility while losing money feels more risky to most people.
Yeah, that math feels broken somehow. Losing money faster looks better. Doesn't compute.
It doesn't align with investor intuition. And the last big one is time dependency. The actual Sharpe number you calculate depends heavily on whether you use daily, weekly, monthly, or annual data.
How can that be?
Because returns tend to scale with time, but volatility scales with the square root of time. So if you calculate a daily Sharpe and then annualize it by multiplying by the square root of, say, 252 trading days, you get a much, much higher number than if you just calculated the Sharpe ratio using annual returns directly.
So those rules of thumb you see online, like Sharpe over 1 is good, over 2 is great,
are often meaningless without knowing how it was calculated. And honestly, for most real-world diversified portfolios over long periods, getting an annualized Sharpe consistently above 1 is actually quite difficult. Those high numbers usually come from annualizing daily or monthly data.
Wow. Okay, that really undermines its common interpretation. Major flaw.
It's a huge source of confusion. And it makes using Sharpe alone for picking funds tricky. Short track records can give unreliable, often inflated Sharpe ratios.
And what about those strategies that seem safe until they aren't?
Exactly. Think about strategies selling options. They might collect small premiums consistently for years, leading to a fantastic Sharpe ratio, smooth returns, low calculated volatility.
Until that rare black swan event hits, and they suffer catastrophic losses.
Right. The Sharpe ratio looked great right up until the moment it blew up. It didn't warn you about that hidden tail risk.
Okay, so summing up Sharpe. It's the standard, it's simple, but wow, it has some deep problems. Penalizes good volatility, assumes neat markets can be gained, tricky interpretation, time-dependent, might miss tail risk.
Which naturally leads us to ask, if standard deviation isn't the perfect risk measure for many investors, is there something better?
Enter the Sortino ratio, stage left.
Precisely. Named after Frank Sortino, developed specifically to tackle some of Sharpe's issues, especially that whole treating good and bad volatility the same problem.
So what's the key difference? How does Sortino try to fix it?
The absolute core difference is this. Sortino only cares about downside volatility. Forget the upside swings.
Only the bad stuff.
Essentially, yes. It measures the investment's return above a specific target you set, often called the minimum acceptable return, or MA, and divides that by its downside deviation.
Downside deviation. Okay, explain that. It's like standard deviation, but only for losses.
Kind of. It's a measure of volatility, but it's calculated using only the returns that fall below your MAR. Any return above your target. In the Sortino calculation, its deviation for that period is treated as zero.
So it actively ignores the upside volatility.
Exactly. Proponents argue this makes it a much better measure of the risks investors actually care about the risk of losing money or just not hitting their minimum required return. It doesn't penalize you for those big winning periods that Sharpe does.
Okay, that clicks conceptually.
Yeah.
If my goal is, say, 5% a year and I make 20%, Sortino says, great, no risk added there. But if I make negative 2%...
That negative deviation below your 5% target contributes to the downside deviation calculation. It focuses squarely on the shortfall risk.
That feels much more aligned with how I think about risk avoiding the losses, hitting my goals.
That's the argument for it. By isolating the volatility below a threshold that matters to you, whether that's zero, the risk-free rate, or maybe the 6% you need for retirement funding, Sortino gives a number that resonates more with the practical concerns of many investors.
How do the numbers typically compare? Is Sortino usually higher or lower than Sharpe for the same investment?
Well, theoretically, if returns were perfectly normally distributed, and you set the MAR equal to the average return, the Sortino ratio would mathematically be the Sharpe ratio times the square root of 2, so about 1.4 times higher.
So in theory land, Sortino looks better.
Yes. But, and this is a big but, Real-world returns aren't perfectly normal, so while Sortino and Sharpe results are often similar on average, they can diverge quite a bit, especially if the return pattern is skewed.
Skewed, meaning not symmetrical.
Right. Think about a strategy that has lots of small wins but occasionally hits a massive home run that's positive skew. Sortino might look really good there because it ignores that big winning volatility.
And the opposite.
A strategy with lots of small wins but a rare, devastating loss negative skew, like those option selling examples. Sortino might look worse than Sharpe once that big loss hits because it's focused precisely on that downside deviation. It's particularly useful for analyzing things with non-normal returns or high volatility where that asymmetry matters.
So Sortino really shines when the return pattern isn't balanced, making the downside risk clearer.
That's often where it adds the most value. Analysts tend to prefer it for evaluating higher volatility stuff or strategies where avoiding specific loss levels is paramount.
Now, you mentioned calculation earlier. The sources emphasize getting Sortino right, especially that downside deviation part. What's the common mistake?
This is super important, as one source really stressed it. The correct way involves looking at all the periods. For every period where the return is below your MAR, you calculate the deviation, how far below. Square it.
Okay.
For every period where the return is at or above your MAR, the deviation is treated as 0. Square it, still 0.
Right.
Then you average all those squared deviations, including the zeros, over the total number of periods. Finally, take the square root. That's your downside deviation.
So you must include the periods where you met or beat the target as zeros in the average. You don't just average the losses.
Absolutely critical. The common mistake is to only look at the periods with losses and calculate the standard deviation of just those losses. That's wrong.
Why is it wrong?
Because it ignores the frequency of underperformance. Think about it. Two strategies might have the same average loss when they lose money, but if strategy A dips below the target 50% of the time, while strategy B only dips below 10% of the time.
Strategy A feels much riskier, even if the dips are the same size on average.
Exactly. By including the zeros for the good periods in the average, the correct Sortino calculation captures both the size and the frequency of falling short. It penalizes strategies that underperform more often.
That makes total sense. Including the zeros correctly reflects the consistency of meeting the goal.
Precisely. It captures that risk of not making your target much better. The source also recommended using a continuous calculation method if possible, rather than just discrete monthly returns, as it handles annual targets more cleanly and reflects the underlying return possibilities better.
Okay, so Sortino focuses on downside, aligns better with loss aversion, calculation details are crucial. Got it.
But there's always a but, isn't there? While Sortino tries to define bad volatility, one source pushed back. Is it really that simple? Is there really good and bad volatility?
Ooh. What was their argument?
They argued that fundamentally variance is just variance. Price movement is price movement. Trying to neatly separate it into desirable and undesirable buckets might be too simplistic, especially since market dynamics change.
So challenging the core premise of Sortino.
Sort of.
Yeah.
They conceded Sortino can look more optimistic than Sharpe sometimes, especially near market peaks when there's lots of upside movement. But they argued the industry sticks with Sharpe maybe less because it's better and more because it's just the standard everyone's used to.
Inertia.
Could be. They used the ARKK ETF as an example, sky-high Sharpe and Sortino ratios in early 2021, right before a massive crash. So even a good Sortino based on the past didn't predict the future downside.
A painful reminder for many.
And they noted that even during corrections, you can have significant upside volatility, those sharp bear market rallies. Think 2008 GFC versus the grind down in 2022. Sometimes the big up days happen during the downtrend.
Right, those rallies can suck people back in before the next leg down, so ignoring all upside volatiles might miss some nuances of bear market behavior.
It's a fair point. Maybe just labeling volatility good or bad isn't always accurate. Still, for the average investor trying to sleep at night, focusing on the downside probably feels more intuitive than penalizing gains.
This talk about downside and crashes naturally leads to the third metric mentioned, the Kalmar ratio. It seems to take an even more direct look at risk.
It really does. Kalmar is quite different. It compares the average compounded annual return, the CAGR, directly to the maximum drawdown over the period.
Maximum drawdown. That's the single biggest drop from a peak to a trough before it starts recovering.
Exactly. For many, that number represents the absolute worst-case scenario they would have lived through, how much they were down at the lowest point. It speaks directly to that feel of major capital loss.
So its strength is its simplicity and directness about the worst hit.
Yes, very intuitive. But its weakness is that it's based on just one data point, that single largest drawdown. It tells you nothing about all the other volatility, the smaller dips, how often you lost money.
So a fund could have a great Kalmar just because it happened to miss the one big crash in the period you measured, even if it was consistently bumpy otherwise.
Potentially, yes. If the measurement period didn't include a major stress test, the max drawdown might look deceptively small. It ignores the general ride quality outside that one event.
So Kalmar is best used over really long time frames that definitely include major market cycles.
That's the ideal scenario for it to be meaningful. Because it gives such a different perspective, focusing purely on the depth of the worst loss, one source actually recommended looking at both Sortino and Kalmar together.
Use them as a team. Why?
Because they complement each other. Sortino tells you about the general tendency to fall below your target, the frequency and size of typical shortfalls. Kalmar tells you about the absolute worst pain point experience historically.
So Sortino for the everyday bumps below target, Kalmar for the potential catastrophe.
Kind of, yeah. Together, they paint a richer picture of downside risk than either one alone. Sortino covers consistency of meeting goals. Kalmar covers resilience in a crisis.
Okay, so we have Sharpe, standard, flawed, Sortino, downside focused, calculation sensitive, and Kalmar, max drawdown focused, data point sensitive. 3 different lenses.
And now, maybe the most crucial point about all of them, every single one, Sharpe, Sortino, Kalmar, is calculated using historical data.
The giant asterisk. Past performance is not indicative of future results.
It's not just fine print, it's fundamental. A great ratio today, based on what happened yesterday, tells you precisely 0, guaranteed, about what will happen tomorrow. Don't get hypnotized by these numbers or think they predict the future.
As they say, you can't eat Sharpe.
Exactly. A number on a spreadsheet doesn't pay your retirement income. Realized returns do. These are analytical tools for the past, not crystal balls.
That's a really important reality check. What else do we need to keep in mind?
Another massive point from the sources. Look at your investments holistically, as a complete portfolio. Don't just calculate ratios for individual stocks or funds in isolation.
Why not? Isn't it good to pick the best individual performers based on these metrics?
Not necessarily. This is the magic of diversification, the core of modern portfolio theory. You can combine 2 assets that look kind of mediocre or even poor on their own risk-adjusted metrics. But if they don't move perfectly together, if one zigs when the other zags sometimes, the combination in a portfolio can have vastly better risk-adjusted returns than either piece on its own.
How does that work? Putting mediocre things together makes something great.
Because their bad periods don't always overlap. When asset A is down, asset B might be up or flat. This smooths out the portfolio's overall ride, reduces the depth of drawdowns, cuts volatility.
Okay, me an example.
One source gave a great one. Over 50 years, U.S. stocks alone, Kalmar ratio about 0.85. 10-year U.S. Treasuries alone, Kalmar about 0.82. Okay, but not amazing. But mix them 50-50 in a portfolio. The Kalmar ratio jumps to 1.80, more than double either one individually.
Wow, just by combining them. That's powerful.
It perfectly shows how the interaction between assets matters more than their solo stats. The diversification benefit is real and measurable by these ratios at the portfolio level.
So analyzing in silos is totally misleading.
Utterly. Another example. A 60-40 stock bond portfolio. Over 50 years, short-term treasuries actually had better individual Sharpe, Sortino, and Kalmar ratios than long-term treasuries.
So you think short-term treasuries would be better in the 60-40 mix?
Logically, maybe, but no. The 60-40 portfolio using long-term treasuries had significantly higher Sharpe, Sortino, and Kalmar ratios than the one using short-term treasuries.
Why?
Because long-term treasuries, despite looking slightly worse on their own metrics, provided better diversification against stock market downturns during that specific long period. Their negative correlation was more powerful in reducing overall portfolio risk.
That's fascinating. The worse individual asset made the portfolio better from a risk-adjusted perspective.
It's a vital lesson. Always evaluate components based on how they contribute to the whole portfolio's risk profile.
Okay, and any final tips specifically for using Sortino?
Yeah, a few practical things. Use a long enough time frame, ideally a full market cycle, booms and busts included. Be super consistent in how you calculate it. Remember, it's especially useful for volatile stuff or where meeting a specific downside target is key. And just like Sharpe, be wary if the underlying assets are illiquid smoothed pricing can make the Sortino ratio look artificially good.
Right. Metrics are tools, need context, careful use, portfolio view.
Now let's make this even more concrete. Let's look at a specific strategy discussed in the sources, one that really highlights these metric debates. It's a portfolio idea, 75% in JAPU.
That's the JP Morgan Equity Premium Income ETF, right?
Yeah.
Lower volatility, income focus.
Correct. And the other 25% in TQQQ.
Whoa, the ProShares 3X leveraged NASDAQ 100 ETF. That's quite the contrast. Stability meets hypergrowth volatility.
It definitely raises eyebrows. The concept pitched was use JPI as the stable core, add TQQQ for a growth kicker, and rebalance annually.
Okay. And what are the metrics?
The creator claimed their backtest showed the 7-5-25 mix had a Sharpe ratio of 0.95, beating the S&P 500 ETF, SPY, and JPI's mutual fund version, JPS, alone over their test period. They even claimed good Sharpe and Sortino ratios held up even at a 50-50 split.
So based purely on those historical metrics, this odd couple looked surprisingly efficient.
According to the backtest presented, yes. But as you can imagine, the discussion in the sources immediately jumped on the massive risks of using a leveraged ETF like TQQQ.
Yeah, things like volatility drag.
Exactly. That daily compounding effect that eats away returns in choppy markets. And the potential for absolutely brutal drawdowns. Leveraged ETFs generally aren't seen as long-term holds for these reasons.
Remind me about volatility drag again.
Sure. If the NASDAQ goes down 10% one day, TQQQ goes down 30%. If the NASDAQ then goes up 11.1% the next day to get back to even, TQQQ needs to go up 33.3%. But 33.3% of the lower value isn't enough to get back to its starting point. The volatility itself creates a drag on returns over time, especially if the market isn't trending strongly up.
Got it. So how did the strategy's proponents defend using TQQQ?
They made a few points. One, the leverage is only in a minority 25% position. Two, things like market circuit breakers, the 20% daily limit in the US, make a total one-day wipeout less likely. Three, they argued that for strong, long-term, upward trending assets like broad indexes, the positive compounding during bull runs can historically outweigh the volatility drag over time, pointing to TQQQ's own large gains since inception as proof.
Controversial point, but okay.
And fourth, annual rebalancing is key. It forces selling TQQQ after big runs and potentially buying more after dips, managing the position size and risk.
So the argument is, yes, leverage is risky, but the structure, minority position rebalancing, and the long-term trend of the underlying index mitigated enough to capture upside.
That's the bull case presented, but the critics push back hard.
Let me guess. Backtesting primarily through the 2010s bull market.
Bingo. They argued that backtesting through one of the longest, smoothest bull runs ever doesn't tell you much about how TQQQ, and thus the strategy, would perform in a sideways grind, a prolonged bear market, or a higher interest rate world where leverage costs more. The great historical Sharpe and Sortino might just be artifacts of a very favorable period.
That seems like a very fair criticism. What else?
The timing of entry. Critics stressed how crucial it is with leveraged ETFs. Buying TQQQ to near a market top could lead to devastating losses quickly. They suggested maybe only adding it during market weakness, using indicators like RSI or strictly dollar-cost averaging it over time.
So the how and when you implement it adds another layer of risk the headline metrics don't show.
Absolutely. This whole example drives home the point. Sharpe and Sortino are useful for analyzing the past, but they're just one input. Even if the back-tested numbers look good, you have to understand the guts of the strategy, the instruments involved, especially leverage, and the potential risks that aren't captured in a simple ratio. Your own tolerance for pain matters way more than a back-tested number.
Okay, pulling it all together then. What's the big picture takeaway on Sharpe versus Sortino?
So we've unpacked Sharpe, the classic standard, measuring excess return against total volatility. Simple, widely used, but flawed, penalizes good vol, assumes normal markets can be gamed, interpretation issues.
Right.
Then Sortino comes along, tries to fix Sharpe by focusing only on downside volatility below a target return, MAR. Better alignment with investor concerns about loss, arguably. But calculation needs care, and the good versus bad vol debate continues.
And Kalmar gives that stark view of the maximum drawdown, the worst historical pain point, but misses the rest of the picture.
Exactly. So the key learn for you. There's no single magic number. Each ratio offers a different lens with its own strengths and blind spots. Relying on just one is risky.
Sharpe is standard, but maybe misleading. Sortino focuses on downside risk, which feels relevant, but isn't foolproof. Kalmar hits the worst loss, but ignores the journey.
Precisely. And never forget the human element, your own context. What does risk actually mean to you? Is it any volatility? Is it the fear of a huge drop? Is it just not hitting your specific goal? Your answer should guide which metrics resonate most.
And always look at the whole portfolio. Diversification can make the portfolio's risk-adjusted return much better than the sum of its parts suggests. Don't get lost analyzing trees when the forest is what matters.
Couldn't say it better. Do your homework beyond the ratios. Understand what you own.
Which leaves us with a final thought to chew on. If, for most of us, the biggest fear is losing capital permanently, and big drawdowns are where that fear becomes real, then do metrics like Sortino, focusing on performance below your target, and Kalmar, zeroing in on the maximum loss, actually get closer to measuring the risk that truly keeps investors up at night compared to Sharpe, which penalizes you for those welcome upside surprises.
It's a great question to ponder. How do you measure risk in a way that reflects what truly matters for your own financial journey and your peace of mind?